All right. Well, you know what? I'm going to go ahead and get started. So I am Andrea Shoup. Thank you so much for joining me today. I wanted to thank Lisa Favorite and also Caitlin for the opportunity to speak with everybody today. So today I'm going to be talking about Proposition 19 and really what you need to know for your clients and talking with them. And so one of the first things I usually do is I just make sure everybody can hear me, but I heard that confirmation that yes, you can hear me. So I appreciate it. So no need to add that to the chat right now. I will also say I am going to take questions at the end. It's just because I have found in the webinar setting, if I'm trying to read the chat and the question answer, I get distracted and it just it doesn't really work very well. So I am not going to be looking at the chat right now, but I will absolutely do that at the end. So please, if you do have a question, I invite you, type it into the chat, type it in there. I'll see it at the end because sometimes it just it is helpful in the moment to write it out and get that in there. All right, so what you're going to discover today. So we're going to be talking about how the law was under Propositions 13 and 58. As well as what happened with Proposition 19 and how things changed on February 16th of this year. We're also going to talk about what you need to know to help your clients. Basically, okay, what do we need to know so we can advise them, help them take advantage of the great things of Proposition 19, and also some planning for the future if they need that. So this is for you. If you advise clients who own real property in California, if you're confused about what Proposition 19 actually does, and you want to help protect your clients. All right. So first, I'm going to tell you a little bit about myself. So I am Andrea Shoup. I spent nearly 6 years in the district attorney's office in San Diego, where I was a felony trial prosecutor. And during that time, I was expecting my first son. And when I learned everything I need to do to protect him, protect my family, I really saw how bad it was for families when they didn't plan. So I wanted to make sure that I got good information out there to people so that they understood the effects of not planning and how to protect themselves, how to protect their kids and their family. And now I have 4 little ones, and I am more passionate than ever about making sure that families have the information they need so they can make the right choices, make the right decisions for their family. So now, one thing I was on a workshop, gosh, a few months ago, and someone asked me, Andrea, how do people know about these changes if they're not talking to an attorney? Unfortunately, there is no good central beacon of information. So I like the opportunity to speak with people so that I can get them the information that they need. So I know the importance of planning, and I know the importance of making sure that we have the right information so we can make the right choices for ourselves and for our family. So, and that is more important than ever with Proposition 19 and the changes, because it had a very dramatic change on property taxes, specifically when properties are reassessed for property tax purposes. Okay, so it's important to understand when it occurs, when is a property reassessed for property tax purposes, so we know how it's been changed and how people are affected. So when does a property tax reassessment occur? Well, it occurs, a property is reassessed or revalued when there is a change in ownership. Okay, when there's a change of ownership, but when does that happen? That happens when there's a gift of the property sales. I know a lot of people here, that's the transaction you're most involved in and familiar with, but a transfer also occurs when there is a death. So when the property owner passes away, basically the instant that they pass, there's actually a transfer that occurs. Sometimes we just don't know exactly who is ending up with that property, but the moment of passing, a transfer has occurred on that death. So, and the property will be assessed when that transfer occurs, unless there is an applicable exclusion. Okay, an exclusion basically is saying, nope, not me. You know, I have an excuse, I have a reason, and some common exemptions are transfers to spouses. There is a very limited transfer to children still available, but it is exceptionally limited now. Transfers to trusts, business entities, and among other types of transfers. So it is important to know when we're talking about it. So this occurs when, and what we're talking about is when there is a transfer in the ownership of the property, and that transfer occurs when there's a change of ownership based on a gift, sale, or transfer on death. All right, so to understand what Proposition 19 did, we kind of got to go back in history a little bit and understand what Propositions 13 and 58 did. So Proposition 13, one thing it did, it capped how the property taxes could increase each year. And it said, all right, you can only, tax assessor, that's the taxing agency, tax assessor, you can only increase the value of the property, therefore increase the taxes by 2% each year, right? That was their cap. So even though the properties were, the values of the properties, they were going up much higher and faster than that 2%, Proposition 13 was designed to protect property owners from skyrocketing property taxes. Okay, that was the whole purpose. And it limited how much a person's property taxes could go up to 2% per year. Proposition 58 allowed a child to keep mom and dad's low property tax value when they received the property from their parents, meaning mom and dad, they had that low property tax assessed value, so their property taxes were low. Well, the children could receive and could keep that low rate when they inherited the property from their parents. As a bonus, Proposition 193, this expanded that parent-child exclusion, the children getting it from mom and dad, it expanded it to grandchildren and grandparents. The catch is that parent in between, so we have a grandchild or grandparents, parents, grandchildren, right? The parents had to have passed away. So if that was the case, unfortunately, then and the grandchild was receiving from grandparents, if that their parent had passed away, then they also got that, were able to retain grandma and grandpa's low property tax rate. But again, the key is that intervening generation, that parent had to have passed away first. So I am going to be talking about property tax rates throughout my talk today. And just for one ease of math and kind of consistently, I've used 1% property tax rate. And I know their property taxes are different based on the area, the county, the city, and the neighborhood, you know, whatever, school bonds and Melrose and whatever else. But for my purposes today, I'm using 1% as that property tax rate. All right, so how did Proposition 13 and 58 actually work in a scenario? So let's just say mom and dad purchased that home back in the 70s for $40,000. The property is now worth $450,000, a significant increase. Because of that 2% cap, right, of how much property taxes could increase, the assessed value of the property is actually only $75,000, which means the property taxes are only $750 per year. Thank you, Propositions 13, right? Now, if the kids were to inherit that property from mom and dad, they keep mom and dad's low property tax bill of $750 per year. Thank you, Propositions 13 and 58. Now, if Proposition 58 and 13 work here, what happens is, let's say their only daughter inherited the property, she would pay taxes on the fair market value of the house because it could be reassessed, because if Propositions 13 and 58 weren't there to help out, which means she would be paying property taxes of $4,500 versus $750. And that's year after year after year after year. That makes a huge difference. The difference in paying $750 and paying $4,500. So now I'm going to talk about Proposition 19 and what it did. And I have here the good stuff of Proposition 19. So I promise you, I am not trying to get political at all. I just, in my world, in my view, paying less in property taxes, that's a good thing. Paying more in property taxes, I don't like that. That's a bad thing. So that's where the good and bad comes in. That's all. I think paying less in property taxes is a good thing. Paying more in property taxes, I don't like that. That's a bad thing. All right. So what are the good things of Proposition 19? So what it did is actually amended our California Constitution. And there is a section that applies to people who are 55 years and older, the severely disabled, or the victim of a wildfire or other natural disasters. And what it does is it says, okay, when you have that low property tax value, remember what Proposition 13 did for us, it kept our property tax values low. If you have that low property tax value, you can take it with you when you move. You can sell your original house with that low property tax rate, and now you could buy another house in any county in the state, and you can take your low property tax rate with you. You can keep your rate plus $1 million. That's a great thing. That saves in property taxes for those who are 55 years and older, the severely disabled, or the victim of a wildfire or other natural disaster. Okay, and that base value plus $1 million, that $1 million, that amount is going to be adjusted each year. I think it's actually every other year. I have a typo on the slide, but the State Board of Equalization, they're going to adjust that every year. This went into effect on April 1st, and now if that person qualifies, they're 55 years or older, severely disabled, victim of a wildfire or other natural disaster, they can take their low property rate with them to any county they want. They can do this up to 3 times in their lifetime. All right, it's limited to 3 times, but they can do this 3 times. They can sell their house, move, and they get to keep that low property tax rate. So how does this work when we are downsizing? Let's say husband and wife, they bought their home in San Diego in the 80s for $250,000. It's now worth $1.3 million. Their property taxes are, they're paying $2,500 a year. And now they want to sell their home and buy a home closer to their daughter. And they bought that home for $600,000. They will continue to pay that $2,500, that low property tax rate when they move to their new house, not that $6,000. That's a great thing. That saves money and property taxes for those who are 55 years and older, severely disabled, the victim of a wildfire or other natural disaster. What happens when we are upgrading? So let's say husband and wife, they're selling their home that has an assessed value of $300,000, a fair market value of $1.2 million. Their property taxes are only $3,000 a year. That's great. Now they want to sell their home and move to Carlsbad, go live by the beach, and they're buying a home for $3.2 million. What do we do with the property taxes then? Well, the first $1.3 million of that house is taxed at that $3,000 a year. Okay, and the way we get that 1.3 million is we take that 300,000 and add that $1 million. Okay, so you get that base amount plus $1 million, and you keep that $3,000. The next 1.9 million, which is 3.2 million minus 1.3 million, right? That next 1.9 million, that is going to be taxed as it normally would at $19,000 a year. So with Proposition 19, they're only paying $22,000 a year versus paying they're only paying $22,000 a year rather than paying $32,000 a year without Proposition 19. So that is great. That saves in property taxes for those who are 55 years and older, severely disabled, the victim of a wildfire or other natural disaster. All right, and that is year after year after year. So $10,000 a year in property taxes savings, that's pretty good. So next, what are the bad stuff of Proposition 19? Remember, my definition of bad is when you're paying more in property taxes. So what happened, and the bad part of Proposition 19 is that it had a drastic reduction in that parent-child exclusion for a primary residence and really any real property. So essentially, children, so remember Proposition 58, and it allowed the child to keep mom and dad's low property tax value? That's no longer available. And so children can no longer inherit mom and dad's low property tax value. There is a small exclusion for if it was parents' personal residence, and now it's child's personal residence. Okay, parents' personal residence, now child's personal residence. And by personal residence, I mean that they have to file the homeowner's exemption with the county recorder saying that it's their personal residence. And after mom and dad pass, the child needs to file that homeowner's exemption on the indicating it's their personal residence within 1 year of mom and dad's passing. Now, if it is the personal residence of mom and dad and now the personal residence of child, they can transfer and keep mom and dad's little property value for the amount of the property plus $1 million. So this is how that works. So let's say that the property was valued, the assessed value is $200,000, but the fair market value of the home is $1.5 million. So that $1.5 million, take off the $200,000 for the assessed value, $1 million for that exemption, that leaves us with $300,000. So the new tax is the 200,000 plus that 300,000 that we had left over for 500,000. That's our new assessed value. And so there is a partial reassessment, and now they're paying $5,000 a year in taxes. That's a bit more than their $2,000 a year, but it's nothing like that 1.5 million they would have been paying on that full $1.5 million. So $15,000 is a much less, or I'm sorry, it's much more than the $5,000 that they will be paid. So again, this is only applicable. The only time children can keep mom and dad's low property tax value is if it was mom and dad's personal residence, and now it is child's personal residence. And I've been asked, well, Andrea, I have 3 properties and I have 3 kids and they're all going to use them as their personal residence. Tricky, but mom and dad can only have 1 personal residence. It's just 1. So you can only file that homeowner's exemption on 1 piece of property throughout the state. You can only do it on 1. It's only applicable for 1, even if you have 3 kids with 3 different properties. All right, what else? What does this do for rentals? It completely eliminated Proposition 58, the children taking over mom and dad's low property tax rate for rentals. It completely eliminated it, including the grandparent-to-grandchild exclusion for all rentals. So yes, rentals will be fully reassessed. Commercial rentals, fully reassessed. Industrial rentals, fully reassessed. That vacation home, that cabin, fully reassessed. There is no exclusion for anything but the personal residence. Okay, so this is how it works. After February 16th, now let's say mom and dad bought their home in Los Angeles back in the 70s for $100,000. It's now valued at 1.7 million. The current assessed value is 200,000. So, and their sole child inherits it. $1.2 million is exempt from reassessment. That's the assessed value of 200,000 plus that $1 million. Okay, so the difference is the new assessed value is that original amount plus the overage of 500,000. So the new assessed value is 700,000. Okay, so they're paying property taxes of $7,000 a year. That's, still a significant increase from 2,000 versus 7,000, but it is a far cry than if they were paying $12,000 a year. So I'm sorry, yes, $12,000. No, I'm getting myself mixed up. $17,000 a year. So it is quite a savings, a $10,000 a month savings. But again, this is only available for personal residences. How does that work with rental property? Let's say mom and dad, or mom bought that fourplex back in the 70s. She purchased it for $100,000. The current fair market value is $2.5 million. The current tax bill is $3,000. After February 16th, if mom dies and the kids inherit the property, that tax bill is going to increase to $25,000 a year. Ouch. That's a big tax bill. So this is how it plays out over 25 years. If, under the previous law, the previous regime of Proposition 13 and 58, taxes would have been paid of $80,000. Under Proposition 19, had it been a personal residence, taxes would have been $280,000. But because it's not a personal residence, it's a rental, property taxes paid over 25 years will exceed $680,000. That's a lot of money. And you can only imagine what it's going to do to rental prices in the future. Those are going to go up, and we could probably foresee families wanting to sell their property because they're not going to be able to keep mom and dad's low property tax value, and they're going to have increased costs because that's a significant increase in what they would be paying. So I'm often asked, well, Andrea, goodness, what's California going to do with all that money? Well, 75% of the additional revenue is going to the California Fire Response Fund. And that is a fund designed to help reduce wildfires and respond to wildfires. And they're actually going to be having the funds available to have full-time staff on each fire department to help suppress and reduce wildfires in California. Wow, that is a great thing. As we know, unfortunately, wildfires can be devastating in our state. The 15% of the revenue raised is going to fund the County Revenue Protection Fund. And what this does is it helps counties who are receiving less revenue, less income, because they're collecting less property taxes. Remember, we talked about the good thing of Proposition 19, where those who are severely disabled, over 55 years or older, the victim of a wildfire or other natural disaster, they can take their low property tax value with them to other counties. Well, imagine that county saying, whoa, I should have been getting $15,000 a month, but I'm only going to get $3,000 a month in revenue. So the fund is to help those counties who are going to be receiving less income, less revenue by accepting those lower property tax amounts. All right, so these clearly have been dramatic changes in property taxes, and it's important to know how it affects you personally, how it affects your family, but really how it affects your clients. I'm often asked, Andrea, can anything be done? Because we're superheroes for our clients, right? We want to know, well, what can we do now? Is there anything that can be done if our clients are in that situation where, ouch, their kids are going to be paying higher property taxes? Well, first, I will say it is important to know the plan. What do I mean by that? There's four major questions. One, is anyone going to live in your home? If so, they're going to live in their home, likely no planning is needed. Remember, if it's mom and dad's personal residence and now children's personal residence, Proposition 19 accounts for that and has a plan. There's no additional planning that's needed. Second, how likely is it that the kids are going to sell the property? If the kids are going to sell the property, no planning is needed. Because the property is getting sold, we don't have to worry about retaining a low property tax value because the property is going to be sold anyways. But if it's likely that the kids are going to keep the property and use it as a rental, a vacation home, or a vacation rental, then yes, likely planning is needed. Another question to ask is, has the property appreciated in value, right? Has it gone up in value? If it's yes to number 3 and number 4, most likely planning is very needed. And it's important to make sure that it is done right and done well. I'll be talking about that in just a second. So when we heard about Proposition 19 and when it came out in November, we quickly saw, oh my goodness, this is going to be a dramatic change. And having clients who have rental properties that are going to be inherited by their kids and working with professionals, advisors, agents who are in a similar situation, we quickly made sure we created what we called a Proposition 19 trust. And it allowed the child to keep their parents' low Prop 13 taxes. It preserved that Prop 13 tax for the children's life. Now, this is not planning that's available anymore. The transfer deed must have occurred before February 16th. And in this, the client remained the settlor, the children were the beneficiaries, so that we triggered that change in ownership. And they still were able to receive a stepped up cost basis for capital gains purposes at passing. So it was very specific planning tailored to a client's specific needs and situation. I will say, and I'm going to invite you to join our advisory network, because for those agents who were part of our advisor network and that we were working with, we could get them this information quickly and they could get it out to their clients and have a solution in place before that February 16th deadline. So then I've asked, okay, Andrea, but it's past February 16th. What can be done now? So now we can use a combination of trust and LLCs. This is complicated planning, and it's very specific to a client situation because we're looking at a lot of different factors. We're looking at the current use of the property now, the income that is being produced by it, the current value of the property, the basis, how much they purchased it for, has it been depreciated, what's the tax assessed value, so many things that we're looking at and thinking about. So much goes into it. But essentially we can transfer the property into an LLC. Ideally it's purchased in an LLC and then transfer it and use transfers through trust and entities to effectuate the transfers we need. I'm actually giving a webinar next week on this topic of how the mechanics of it and how we're using the trust and the LLCs. So I'll invite you to that as well. But with this type of planning, and really with any type of planning, you've got to carefully evaluate the situation. Telling you this planning is not for amateurs. It is not a DIY project. There's no readily available like easy solution like, oh, you just do this to do Prop 19. It just doesn't work that way. Topics that you've got to consider is, should you give away their property? What are the capital gains tax effects, property tax effects, income effects, income tax effects? There is so much that goes into it. And it's really important to understand also. Sometimes I'm like, well, some people tell me, well, Andrea, I have a revocable living trust. You said something about a trust. Don't worry, I got a trust. I'm good, right? Isn't that enough? No, not even a little bit. Most revocable living trusts, they are not designed to protect against property tax reassessment. Okay, that is just not what they're set up to do. It is not designed to handle that. So a revocable living trust, a standard trust, does not solve what I'm talking about with Prop 19 and those property taxes. Then somebody asked me, well, then what's the point of having a revocable living trust? I'll just tell you that kind of breaks my estate planning heart. No, but really, because there are so many benefits to a revocable living trust. One, it avoids court. It avoids probate court. It avoids conservatorships. I will tell you, I have spent nearly my entire 15 years in practice in court, first in criminal court, the felony trial prosecutor, now in probate court. Nothing good happens in court. You want to stay out of court, okay? A revocable living trust helps save tens of thousands of dollars in legal fees, saving 2+ years of a headache in going through court, avoids family fights, avoids uncertainty, making sure that someone can choose for themselves who comes in. And I will tell you, all homeowners in California, they've got to have an estate plan. They really should have a revocable living trust. If you're interested and want to learn more, we do webinars and workshops quite often. Go to our website, shooplegal.com. We have upcoming events, and right now our upcoming event is a webinar on how to use LLCs and trusts to reduce Prop 19 taxes. So that is going to be on April 20th at 4:30. I invite you, please attend. If you want to sign up, you can go to our website, the one I just showed you, shooplegal.com, and go to upcoming events. Also, you can join our advisor network and you'll be getting emails about it as well. So the benefits of joining our advisor network is, one, you're going to be the first to know of the updates in the law. We also provide resources for building your business. You have VIP access to our network because we have several events throughout the year. You have the opportunity to receive exclusive trainings on topics that really affect the real estate industry, as well as access to trainings for your clients. To join our network, it's very easy. Just email info@shooplegal.com, subject advisor network. Email that to us. You'll get a welcome email and then information. No, we do not spam you. I can't stand that. It really is just, it's useful information applicable to agents as to keep you informed of what the law is, how it's changing. and also tips to build your business and help you continue to grow and develop. When I say access to trainings for your clients, we do estate planning workshops. And if you had questions or wanted to get that type of training out to your clients, we actually personally brand the training to you to provide to your clients. And that is a lot of times a very useful and helpful for you as well. Anyways, if you're interested, please email info@shooplegal.com, subject line advisor network. And now I am ready for questions. So thank you. I really appreciate the opportunity to talk with you today, and I'm very excited to hear your questions. So I am going to stop sharing my screen.